Welcome to Financial Fortitude, the podcast that's all about tackling personal finance with a blend of wisdom and a laser focus on purpose-driven decisions. In today's episode, we're exploring those moments when the math just doesn't add up, whether it's a budget that refuses to balance, an unexpected health setback that demands a lifestyle overhaul, or a grocery bill that mysteriously doubled.
We'll dive into how life can throw the numbers off course and why sometimes it's not just about the math, but about the choices that make the most sense for you. Stick around till the end where we'll break down a real-life case study and explore the decisions that worked best for this particular client. And remember, life doesn't happen in a vacuum. If you're ready to stop sweating the small stuff and start finding meaning in your financial journey, you're in the right place. Let's dive in.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, are you ready for today's episode? I'm very excited to review the topic that we have today because it's a little bit different from what we've talked about, at least in the past.
Yeah, Brady, I'm super excited about this topic as well because it's something that a lot of podcasts, in my opinion, don't focus on, right? A lot of podcasts will focus on the things that you should be doing or shouldn't be doing or the things that you need to watch out for, but very rarely do they ever pulse check when life throws curveballs at you, right?
Yes.
And these are certain things that you can't necessarily fully be prepared for through, some sort of walkthrough, if you will, like you would before a competition. But life does happen, so it's a matter of how are you prepared and are you ready to navigate or wade through those waters that start to rise on you.
Yep. And I think oftentimes the challenges, especially in today's episode, as we'll discuss here in a moment, but the challenges are in no one's financial plan, right? When most people sit down with an advisor, when most people are reading through what is like, hey, the best decision making to consider before implementing a financial plan, it's very infrequently that, hey, getting injured is in your financial plan, or it's very infrequently that losing your job is in your financial plan, right?
Or maybe even a large windfall, right?
Yes.
Receiving a large sum of money to look at a positive note, right? Not to be all dreary with things, but life does not happen in a vacuum, so your financial plan shouldn't be built in a vacuum either, which is why proactive planning makes so much sense and where set it and forget it type variables can kind of go out the window in my personal opinion. But the one thing that I think we're going to really hone in on today is the difference between what's rational and what's reasonable. And this concept is ingrained in my mind after reading the book, The Psychology of Money, written by Morgan Housel. One of my favorite books, easy read. I know you've read it as well. Anyone who wants to get engaged with their personal finance should take the time to read this book because I think it's so great. And it's very easy to digest for all different levels of confidence with personal finance. But the biggest quote that stuck with me from this book is where Morgan Housel states, people do not want the mathematically optimal strategy. They want the strategy that maximizes for how well they sleep at night, right?
Yep.
And it's very cookie cutter to say, well, what's going to allow you to sleep like a baby at night? It's true, though. Right?
Oh, very much so. Rationally, what allows you to sleep best at night is having the most mathematically developed financial plan, right? From a rational person. But reasonably, we all know that having a math problem essentially determine exactly how you're going to live your life financially and otherwise is not at all what helps me sleep at night.
Right?
I don't want an equation telling me what my life is going to look like now and in the future.
And the rational aspect of it, a lot of the times is the technical analysis. Right?
Yep.
Anything that somebody who's really good at Excel or who's really good at mathematics or statistics can populate or produce at any given moment. The reasonable aspect of financial planning is, again, what's going to align with you and ease your stress and anxiety or maybe even frustration or even worry. And we don't often show the stresses or anxieties on our sleeves. We try to button it up and keep it behind closed doors. But that's where, when sitting down with a professional, you're able to unravel those and find that vulnerability to be able to share, hey, this is what's really got me geeked out right now. Like, I don't know what would happen if X, Y, and Z occurred in my life. And
or
so
A, B, and C has occurred in my life, and now I don't know where to go next, right, is oftentimes the question because the math problem isn't working anymore.
yeah, and it can be as simple as losing your job unexpectedly, right? And not having enough savings set aside to be able to withstand the storm at hand. It could be, to your point, to where you have a sickness or injury, kind of like the case study we're going to talk about today, unexpectedly, something that just occurred that you were not planning for in the mathematics of the long-term financial plan. So this is where, when designing a financial plan as a consumer, that you want to make sure that your financial plan is flexible, right? You want something that's nimble, something that's going to pivot and adjust as life evolves, whether it's in a positive manner or in a negative manner. And it gives you the grace to find optimism in your current and potential future financial well-being.
Yeah, I think that's super important. And then the other thing to consider there when designing, hey, how do I design a flexible plan? I'm not exactly sure what the future looks like. It's getting really serious, and we've talked about this in prior episodes, but it's getting really serious as to, hey, what's your purpose? What's driving your decision-making? What goals are most important? And then how can we be flexible to still accomplish or work towards those particular goals, even if the plan needs to adjust along the way?
Correct.
But let's talk more about, or even jump right into, our scenario, because I think that's going to drive most of our conversation, and probably what the listeners are most interested in hearing is, hey, I haven't experienced a life-altering event yet, or my financial plan hasn't gone off course yet. What does that look like for people?
Yeah, and surprise, surprise, life-altering events don't just occur to those who are on the back nine of their life or their financial journey, right? It can happen to anybody along the way, no matter where you're at in your financial journey. Now, for this individual, this is a single individual. I got introduced to them when they were 38, 39. They're now 44. So single and pretty attractive balance sheet in the sense that they own a home, they have strong income in the six figures. They used to have student loan debt that we've since been able to get forgiven through public service loan forgiveness. So that was a massive win for them over the course of the last year and a half or so when they got that award letter. And the biggest focus up to this point has been, how am I managing my financial immune system, but also how am I striving to become that extraordinary wealth builder, that EWB, sure, and putting the parameters in place through automation. Now, where life started to get tricky was within the course of the last year, this individual went through an unexpected health scare. Okay. Health scare in the sense that they started to frequent their doctors because of some negative effects that started to arise medically. Now, there were massive changes that had to occur with the specialists that they were seeing because the primary care physician was not able to support them in the full manner that they needed. Personally, they also decided to take a different approach to medicine, pushing them to specialists that were not covered within network.
Sure.
Right?
Assuming that this person is a W-2 employee, is getting their coverage from their employer somewhere.
Correct. And to be explicit, this is a W-2 employee. They're getting their group benefits from their employer. Okay. And they had multiple plans to choose from. And so from a planning perspective, prior to them having this health scare, we were more than likely looking at a high deductible health plan, coupled with a health savings account just to be more optimized, right? Keeping the premiums of the health insurance low, getting triple tax advantage funds set aside for future medical expenses. And now it's a matter of, well, do we look at a PPO plan, something with a low deductible, maybe a higher premium on the health insurance, just so we're paying less out of pocket?
Sure.
Okay.
But what I'm hearing is, up to this point, this particular client was essentially a model for getting out of student loan debt, a model for building a balance sheet, a model for, hey, my financial plan is going according to plan right now. Everything's on track.
Correct. And we were hitting that 20% annual savings rate target minimum.
Oh, that's
right?
great.
And so again, on that EWB status, and fast forward to within the last year or so, and now these medical bills are stacking up. Now it becomes a conversation of, well, the specialists that I'm seeing that I'm having the best results with, they're not in network. How do I better manage this? Do I take on the medical bill debt and understanding how those might be negotiated, or if I'm having to put them on credit card, understanding the ramifications of higher interest debt? Or do I have to alter my overall lifestyle, right? Maybe do less of the activities that I enjoy, less of the personal pleasures to be able to offset that cost? Or do I take it from the forbidden fruit of reducing my personal contribution to retirement?
Do I rob myself and my financial plan in the future to essentially address the life challenge that I've been thrown or otherwise was not expecting under any circumstance 3 years ago, 5 years ago, 10 years ago when I laid out all of the goals that this individual had?
Correct.
Yep.
And I think that's where a lot of us can get caught up, is that we've been ingrained, or it's been ingrained in our minds, that you cannot stop funding your 401k. You cannot stop funding your IRA or your Roth IRA or your 403b or your simple IRA or your SEP IRA. It doesn't matter what type of profession you're in. If you stop funding that, you are going to be unsuccessful in the future. And I think it's, in my opinion, a scare tactic. Now, I'm not saying that if you do not save in a prudent manner, that you'll still find financial success and freedom in the future, because it won't work, right? You have to be setting money aside. But where you set money aside is the bigger conversation that needs to be had. And the mainstream myth is that pausing retirement contributions for 1 to 2 years is going to lead to financial devastation in the future because of the assumed compounding interest and assumed market growth that occurs year over year, which you and I know. You don't get the same consistent market returns year over year, right?
No,
if anything,
never.
What we're looking at are the long-term average returns, the annualized returns. And unfortunately, that's what dictates a lot of the decisions that are being made today.
Oh, certainly. And I think just as much as you're looking at the long-term returns, what we tend to find or really encourage clients is it's the long-term habits that you have, right? At the end of the day, you taking a pause or a break from savings is not going to completely disrupt your financial plan, just like taking that weekend or week off from the gym is not going to ruin your physical appearance, right? You don't lose your six-pack by not going to the gym for a week. You lose the six-pack by not going to the gym for 2 or 3 years maybe, right? Not having the habits in place to continue to upkeep what is otherwise a healthy body, a healthy financial plan.
Yeah, and I think the other insecurities that can arise in making the decision to potentially pause contributions to a retirement plan and maybe redirecting them into a more liquid type of investment vehicle, like a non-qualified retirement account, which, just for those of you who may not be familiar with that terminology, that's just a non-retirement after-tax brokerage account, right? Something that's a little bit more accessible, still being invested in very similar type investment vehicles, or having the option to invest in similar investment vehicles, just more accessible from a liquidity perspective. So you can still save outside of your retirement account, which could offer more favorable potential outcomes in a shorter time horizon if you're needing access to liquidity within the next 3 to 5 to 7 years. So the insecurities that will arise is when you're talking to coworkers, when you're talking to friends, when you're talking to family members, and they're talking about the returns that they're getting in their 401k or the returns that they're getting in their IRA, or how much they're contributing to their Roth, or how much they're contributing to their 401k. That's when the internal insecurities will arise, and it'll cause you to start questioning, well, am I doing the right thing? Am I putting money in the right places? Am I really leading myself to future financial devastation because I'm not contributing to my retirement plan at work? And that's where we have to rein our clients back in and say, hey, focus on playing your game. Focus on where the chips on your board are. Don't look at your friend's board, because they may not be playing the same game. They may be playing a completely different game, and what's right for them may not be what's right for you.
So let's take a pause there. The client in this situation, from a planning perspective and a purpose-driven perspective, what's important to them? What are they planning for? What do their goals look like? Because that's the game that this person really should be most concerned about. What's my game look like?
The biggest focus for this client was wanting to continue to save aggressively, which is awesome. That's a good attribute that we as consumers should have as we're striving towards financial freedom. They also wanted to be able to continue to improve quality of life. Quality of life was something that continued to arise in our conversation.
Okay.
Right? And the medical scare got so dire that this individual told me, well, I don't know if I'm going to be alive in the next 12 to 24 months. Okay.
That's heavy, right? That's a very challenging conversation to have.
And so then it's a question of, well, do we maximize our time on this earth knowing that tomorrow is not promised? Or do we focus solely on the long term of what the financial future could like and the negative effects that could come along with that if we're going to ignore our current situation, right? We can continue to say, hey, I'm in a lot of pain medically, I'm very uncomfortable, but I will sacrifice going through that just so that I can secure a higher probability of financial success in the future, right?
The math problem, right?
Yeah,
I'm building my math problem.
Yeah, it's sad, but it's not just for those who are having health scares at 44. It's also those who decide to work their entire career, get to 65, 66, 67, decide to retire, and then in 1 to 2 years, they're no longer on this earth because something came up. That's sad.
The more common story, I think, that we see, at least from experience. It's not as often we see someone in their mid-40s with a health scare where they're questioning, what does next year look like? What does the next 5 years look like realistically, life-wise for me?
And in this scenario, in consulting with the client and going back and forth, it was really their main concern was, well, I don't want to continue to accumulate debt from these medical situations. Like my hope, and hope's not a strong strategy, but hope is real. You have to have hope when you're going through medical scares and health scares. The hope was that, hey, if I pause my contributions to retirement, forego the full match that I'm getting by my employer, right? Because that's an aspect that we haven't talked about yet is the match, right? Hopefully I can pick it back up and re-contribute to the retirement plan once my health starts to turn around and I can become more consistent from managing these symptoms long term, right? Assuming that I'm still on this earth. But in the meantime, let's redirect to somewhere that's more liquid so that in the event I need access to funds, I haven't handcuffed myself by putting everything under the sun that I'm saving into a tax-deferred vehicle that I'm technically not supposed to tap into until I'm age 59 and a half at the earliest.
Yep. And so I think the biggest takeaway that I have from that conversation, from that thought is, if you're this individual or if this is a scenario that you find yourself in as any client, it's not about looking over the fence anymore and saying or asking, well, what are my friends and family doing? What are my coworkers doing? This individual or anyone in this type of circumstance, they're just simply not playing the same game as the person who's otherwise healthy and their financial plan has yet to be interrupted or challenged in any capacity. And I think that's the important thing of, hey, there's certain strategic decisions we absolutely can make. There are certain things you absolutely must consider as to how it might affect the future and what does life look like right now. But I think the big encouragement in the art versus science of financial planning is understanding that life is more important than the math problem at some point. It's about assessing, hey, what is most important for me here and now, knowing that I've done a great job up to this point, and if things do continue to get better, as I'm hopeful that they will, right, that we can get back on track. Your financial plan isn't determined by 1 year's worth of your habits.
Correct. And this is where having a nimble and flexible plan comes into play, to where in this scenario, we said, okay, well, we were putting 10 to 12% of your earnings into your retirement plan in order to maximize the match from your employer, right? And keep in mind that matches that are offered by employers typically have some sort of vesting schedule. And so if you haven't fully vested, then that match is 100% yours anyway. So you're not really leaving money on the table. In my mind, you're only leaving money on the table if you're fully vested. And so in this scenario, we said, okay, well, what if we took 3/4 of what you were contributing to your retirement plan, or even 100% of it, and forego the match and redirect that through automation into what you and I call a midterm bucket or an opportunity bucket, which is that non-qualified, non-retirement after-tax investment account. And we set up the automation very similar to a 401k to make ongoing contributions into that bucket. For the time being, we'll put it into a cash type fund, maybe a high yield money market fund, maybe a little bit of it into the stock market for the potential for higher returns, right? Nothing's guaranteed in the stock market. But the idea there was that we were building a liquidity reserve above and beyond any sort of emergency fund. Now, why? Because as medical bills arise, we then control our decision-making process of saying, okay, I can either negotiate 0% interest repayment plan to the medical institution that I've received services from, or I can pull the money from this opportunity fund to then cover that expense in full.
Yep.
Right?
And what happens if none of those funds are needed? What then?
Well, if none of those funds are needed and the expectation is that this client will get healthier, right? Their health will improve over time. Then what we do is we just adjust the allocation to saying, okay, well, instead of doing 10 to 12% to the retirement account, why don't we increase up to the match? In this scenario, the employer matches dollar for dollar up to 8%. So we would put 8% there, and then the other 2 to 4% to get to that 10 to 12 range would then continue to go into that midterm bucket or that opportunity bucket, right? Because we want to continue to build liquidity. And the idea here is that when fast forward for this individual, 20, 23 years down the road when they reach age 67, which is full retirement age based on Social Security today in our country, we now have blended diversified assets that we can pull from to derive their income need, their income streams that have different tax advantages, pre-tax versus post-tax. Again, a completely different topic for another day, but we're building more freedom and flexibility and options for this client versus the traditional methodology of everything going into retirement and maybe some of it going into a personal savings account.
Sure. So what I'm hearing is that this client, in just simply being more flexible, changing decision making, and really taking things day by day rather than fast forwarding 20 years in the future and essentially running their financial plan as a math problem, is success is still very much in the picture, but it may just simply look different from the traditional success or the original success that we had been planning for. Does that sound right?
That's absolutely correct. And I think the biggest emphasis that we applied for them was that, hey, let's focus solely on maintaining our disciplined habits around saving at an EWB rate, right? And let's worry less about where we're saving that money. It's still important. I'm not going to diminish the importance of it because asset location is very important, where you park your funds that you're setting aside. But for the primary execution of where this individual is at in life, it was more so, hey, we need to focus on getting you healthy. We need to focus on quality of life, right? Because tomorrow is not promised. But we want to continue to make sure we're saving at the right clip. Because the more you save in the right place, the better off you're going to be from a flexibility and control standpoint when it comes to your personal finances.
And I think that's why it's super important to have a financial professional that you can be open and honest with foremost. Like, hey, I am experiencing this life situation. I do need guidance. I also think it's important to have a financial professional in your life that is comfortable being flexible alongside of you and not putting the pressure on to continue to make certain decisions versus other ones, especially when comfort and your life is really the ultimate decision maker. That's the ultimate effect is, hey, if I keep making these 401k decisions, I may find myself in a place where I have less and less flexibility to adapt, but the math problem is still working. And then I think it's important that clients speak with a financial professional who can help them define success and what it means to that person individually based on their goals, right? I heard from you that this individual, their biggest goal or purpose was to continue to develop more financial freedom, more financial flexibility, and a lifestyle that they can enjoy living. They're working their butts off to save as much as they can and be an EWB, and they want to reap the rewards of those great habits after a while. So having a financial professional who can help really define success right alongside of you and then be super flexible in efforts to adjust what that success looks like when the time comes, whether it's good or bad, is really helpful.
Yeah, and that's where success is in the eye of the beholder, right? I tell everyone, and I think you express this as well in your client consultations, that success is purely subjective. You as the individual or the family, the business owner decides what success looks like. And success is going to evolve over time because it's not defined in a vacuum, right? And so for this individual, initially it was, hey, success for me is getting out of student loan debt while still saving some money along the way. And then that transitioned into, hey, success is now saving aggressively across various time horizons, short-term, mid-term, long-term, right? Another way of looking at that is emergency fund, opportunity fund, or midterm bucket, and then long-term retirement funds. And life coming up and saying, hey, we're going to throw a curveball at you and see if you can hit this, right? Or are you going to strike out? It's really a matter of saying, okay, well, now how do I pivot to what success looks like today? And for this individual, the definition of success is quality of life.
Yeah,
being able
healthy.
to enjoy life, getting healthy, and not falling into consumer debt or medical debt because of this life event, right? Not allowing life's events to dictate how you adjust and make financial decisions, but making financial decisions based off of where you're at today and you controlling the situation to the best of your abilities.
So, Michael, tell me this then. right, as we're consistently redefining success in clients' financial plans, the question that I have is, what could this individual specifically, or maybe what I'm most interested in is an individual who hasn't yet been thrown that curveball. What can they do so when a curveball comes, there's not this, oh crap moment, I don't know what to do, or I'm in a place where I'm not flexible, and now I'm in just as much of a challenge or predicament just because my idea or version of success has changed and life has gotten in the way.
Yeah, I'd say some of the things that clients can do, and it's going to be different depending on which side of the aisle you're on, right? We coach clients through this idea that, hey, there's really about 3 different phases of the financial journey that you're going to go through. You have the accumulation phase, which is while you're working and squirreling away as much as your wealth as possible onto your balance sheet as opposed to the balance sheets of others, up until you get to about 10, maybe 7 years out from full retirement when you decide to exit the workforce. Once you get to that next second tier, then it's more about capital preservation, protecting what you've accumulated and getting less speculative, right? Taking less unnecessary risk. And then once you get into retirement or the distribution phase, that's when it's all about spending the money that you've accumulated and enjoying life to the best of your ability. And hopefully you've found that balance to where you're, along the way through accumulation, capital preservation, and spending or distribution phase, that you've got to enjoy life along the way. Well, for those in the accumulation phase, things that you should be considering is, well, how do I build enough liquidity on my balance sheet to take control of these decisions that arise? And who can I partner with to help bounce these concerns off of, or to meet with on an ongoing basis to reanalyze the equation that we continue to reference and refer to?
Because to redefine success.
Redefine success, because the equation never goes away. It's just that the output, the decision, isn't always the mathematical decision. Sometimes it's the behavioral or the emotional decision. And just because it's emotional doesn't just mean that it's inherently wrong, right? Which goes back to what's rational and reasonable.
Yep.
And on the distribution side of things, for someone who's in retirement, I think we can all agree that there's more comfort in our lives when we have more guarantees that we can expect, more guarantees to look forward to. And so on the retiree side, we're able to remove a lot of the concerns and anxieties and emotions around living the rest of our life on a quote unquote fixed income, right? If there are more guarantees establishing a baseline for us. If we know that, hey, each month or each year I have X amount of income coming in, guaranteed, no matter whether the stock market's up or the stock market's down or the stock market's flat, there is more clarity, there is more confidence, and there's more flexibility in that versus if your income is solely variable based on all these other external situations that are arising or that are going on.
Yep. What's happening out in the world? What's happening out in the economy? How is my portfolio doing? Right? Those are worries that retirees have on a day-to-day basis. And for some individuals who have built more flexibility into their plan, for individuals who have redefined what success looks like, right? Those individuals can feel much more comfortable, safe, confident, even though the math problem might not be perfect. It's reasonable for them, right? It's what makes most sense for what's most important behind their purpose and the goals that they have. So, what I'm hearing from you is, if I'm in that accumulation phase, how do I prepare for life's curveballs? It's being open to redefining success on a regular basis with someone who you can bounce ideas off of. It's being open to perhaps not look over the fence on a day-to-day basis and say, am I maxing out my 401k? Right? It's using other buckets of money to your advantage. And then for those clients who are approaching retirement or maybe already retired, it's assessing from a planning standpoint, is there a better way to do things? What's most important to me? And what does success look like? How does it feel once I'm no longer working anymore? Right? It's different for everybody.
No, yeah, it's going to be different for everyone. And we tell everyone, very similar to the CFP board exam, all the answers are going to be good answers, right?
It's there's just one right one.
Yeah, there's one right one, and there's going to be a better best answer. At the end of the day, you as the individual, you as the family, you as the business owner has to decide based on all the facts, all the details, all, the different scenarios that have been presented, which one is the better best answer for you based on your definition of success. And hopefully you're partnered with an advisor that's going to that level of work for you, that's reanalyzing time and time again the 4 primary domains of your overall financial balance sheet. Your financial immune system, how are you managing your risk? Cash flow, which is the living blood of your balance sheet, right? As well as assets, the things that you own, and your liabilities, the things that you owe to other people. If you're not reviewing that on an ongoing basis and combing through the data and just making sure that things are on track, then if you're not reviewing those 4 primary domains, then you might want to reconsider partnering with somebody who's going to take that extra level of assessment and care for you to make sure that you're firing on all cylinders.
Sure. Yep. And consistently redefining your North Star, which is your goals, right? Your balance sheet is driven by what's most important. I'm excited and hopeful to see this particular individual step through this financial challenge and come out on the other side with a newfound financial confidence that flexibility and adaptability is really what builds the strongest financial plans rather than the math problem itself. And I'm sure we'll continue to hear from you, hopefully, as to that continued success.
No, I am as well. And we'll maybe once we get more insights on the outcome, we'll be able to revisit this case study and add a happy outcome to the end.
Yep. Great. Thanks for tuning into this episode of Financial Fortitude. If today's discussion on how life can throw your numbers off balance resonated with you, don't keep it to yourself. Share this episode with a friend, family member, or colleague who might need to hear it too. And if you've got a story where the math didn't add up, but life kept moving forward, we want to hear it. So reach out directly by dropping us a message on our website at www.genesiswealthplanning.com/contact. And remember to subscribe so you never miss an episode. And leave us a review to let us know how we're doing. Until next time, keep making purposeful decisions, no matter what the numbers say, as you strive to become an extraordinary wealth builder. Thank you for joining us this week on the Financial Fortitude podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning, LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult with your tax, legal, or accounting professional regarding your individual situation. Michael Acosta and Brady Hammerly are registered representatives and financial advisors of Park Avenue Securities, LLC. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC, financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian Consolidated Planning Group, Inc., and Genesis Wealth Planning, LLC are not an affiliate or subsidiary of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974, Brady Hammerly's California Insurance License Number 4353077, 6991809.2 expiration 1026.